Hi, it's Mark Wisniewski, and I'm the portfolio manager for all our fixed income funds, the Diversified Bond Fund, the Core Bond Fund, and the Credit Income Opportunities Fund. I wanted to start off just talking a little bit about 2018 and what that means, obviously, for 2019. 2018 in fixed income world will probably be categorized as one of the most difficult years that we've had in probably as many as 10 years. Literally nothing worked in fixed income in 2018. Government yields, although they didn't end up the year as high as they were, ended up higher on the year. Credit spreads for investment grade and high yield ended up wider. That is, investment grade and high yield bonds underperformed government bonds. So in general, most fixed income returns were negative last year. So, and that's very, very unusual because you don't really see an environment where interest rates go down or they don't go up that much, and credit spreads or in credit high yield and investment grade really underperforms. It's usually when interest rates, when credit underperforms, interest rates go really low. So as I said, it was a little bit of a difficult year, and I'm fairly optimistic about 2019, and I'll explain why. One of the things that happened in the end of the year was there was a big fear of recession risk that was not even evident throughout most of the year. Generally, all the economists that we talk to, most of the people that we listen to, would tell you that there wasn't a chance of recession until sometime in 2020. The expectation was that the Bank of Canada was going to raise interest rates 3 times in 2019, and the Federal Reserve are also going to raise rates 3 times in 2019. And what's happened with all the volatility, and much of it related to trade talks between China and the US, some of it's related to lower oil prices, lower commodity prices, some of it's related to a slowing in China. There's also the fear of some real issues in Europe related to Italy and, of course, Brexit, a potential for a reasonable slowdown, the yellow vest protests in France. So there's a lot of things going on that really worried the market about the world going into a global recession. So what's happened since then is that the market has basically taken every rate increase off the table for 2019. So the consensus right now is that the Federal Reserve and the Bank of Canada will not raise rates in 2019. So what happened is that we initially thought that we were going to have a neutral rate that was very close to 3%. And what that means is that the neutral rate is something that we use to give us sort of a marker to where we think 10-year and 5-year interest rates will be. And the fact that they've taken those interest rate increases off the table has meant that both 10-year Canada's and 10-year US Treasuries have gone down in yield substantially. So the high point for Canada in 10-year government bonds was about 2.6 last year, and we're back down to about 1.94. So we've had an immense move lower in yield, and again, that's on fear of recession. And the same thing is true in the US. We were at about 3.25 in US 10s, and we've moved back down to about 2.68. So we've had a real unwind in that move higher in interest rates. So for 2019, I find it really hard to believe that we're going into recession, primarily because the economy in the US and Canada are probably going to be slower. Bank of Canada thinks that the economy grows at 1.7 next year, and the Federal Reserve would tell you that they think the economy is going to grow at low 2s. So that's not exactly recession. So with that, I think that it's probably likely that both the Fed and the Bank of Canada raise rates one more time this year, and they bring that neutral rate in Canada up to about 2%, and the U.S. they bring it closer to 2.75. So with that, I think we're going to get a little bit of a drift higher in interest rates in Canada and the US, but we're not going to get up to the highs that we got up to in 2018. So probably a more realistic level for 10-year governments this year in Canada is probably somewhere around 2.25. And in the US, it's probably something like maybe 2.75. Maybe if we get a little bit of inflation, somewhere around 3%. And the other thing that everybody's been talking about is the yield curve. And for us, the yield curve is important because it embeds a lot of information. And what's happening is that the yield curve, because of what's just recently occurred, is flattening. So what that means is the interest rate differential between, for example, a 2-year government bond and a 30-year government bond, that interest rate differential is decreasing. And when the yield on a 2-year and a 30-year bond are basically the same yield, that means that the market's fear is that the yield curve goes inverse next, which means that the yield on a 30-year bond is less than the yield on a 2-year bond. And right now, we're at a point where we are flattening, but we're not inverse yet. But I would say at the trajectory that we're going, the yield curve could possibly be inverse by the end of this year. And what that indicates is that when the yield curve goes inverse, we should have a recession at some point in the future. The problem is the yield curve is a very, very good predictor of recession, but it's not particularly good on timing. In the mid-90s, when the yield curve went inverse, you didn't get a recession for probably 4 years later. So recession will happen, but it's anybody's guess at what point it will happen. So our models say right now that the shape of the yield curve suggests that there's a 30% chance of recession in the future. So it's still low, but it's growing, and it's something that we have our eye on. And as I said, again, we think recession is probably more likely a 2020 thing. We grow at a slower rate this year. Interest rates move a little bit higher. The Bank of Canada and the Federal Reserve both raise interest rates. Okay, so what does that mean for fixed income, and what does that mean for funds? Well, first of all, what happened with this recession risk is that the spread, the credit spread on investment grade and high yield has moved out quite a bit. And the reason it's moved out quite a bit is that anytime you get a fear of recession, credit spreads widen. And the way to think about credit spreads they're like an insurance policy. So when things are really good, you don't need to pay much for insurance. When things get a little bit more choppy, you have to pay more for insurance. So the insurance premium on investment grade credit has been increasing primarily because everybody thinks that we're potentially going into recession, which again, I don't think is happening in 19. I think it's a 2020 thing. But notwithstanding that, credit spreads, high yield has gotten cheaper. So what I like about that is that we can buy high quality investment grade credit. We can buy Canadian banks, we can buy insurance companies, we can buy all sorts of good quality Canadian companies, names that you all know and have all heard of, and we can buy them in what I would say is at a sale price right now. So where we could used to be able to get a yield that was substantially lower in investment grade, in 3-year and 5-year investment grade credit, we can get anywhere from almost 3 to 4%, which is a lot more. It's probably a percent higher than it was over a year ago. So we're getting paid more to buy investment grade. I don't think we're in a situation where we have to worry about recession. So consequently, we're really excited because we can put more yield into our portfolio. So without taking duration risk. And which is really important right now, because as the yield curve goes flatter, and again, the other way to think about it is that the difference between buying a 3-year corporate bond or buying a 30-year corporate bond, the added benefit, the increased yield you get for buying a longer dated security has really, really shrunk. So what we're finding is that we can buy much shorter dated credit at a very, very attractive yield level, and we don't have to take a lot of duration risk and add interest rate risk into the portfolio. So that's that's really our favorite spot to be right now. Is we prefer to be in short-dated credit. It's something that we've been buying for a while. But the beauty of it is that the yield that we can get in the portfolio now is now approaching more than 4%. So our expectation is this year that the diversified bond fund could return 4 to 5% this year, because we have the ability to buy securities that are much cheaper and much better priced. In our credit income opportunities fund, where we use leverage, and basically we are leveraging investment grade credit to create a security that yields, in some cases, 50, 75% more than the investment grade bond that we buy. The opportunity credit income opportunities fund could earn 7 to 8% this year. So we're pretty optimistic on returns this year, primarily just because we can buy much better priced credit. We don't think we're going to have the issue whereby we have a big move in interest rates this year that take out some of the portfolio return. So overall, we're pretty optimistic. Our new core bond fund has a yield right now of about 4%. The expectation on that fund this year is somewhere between 3.5% and 4.5%. It's a great option if you want a fund that has a little bit more higher quality. We buy government bond funds, we hold government bonds in this fund, and as I said, it has a duration of about 4 years and a yield that's very close to 4%. So it has great characteristics. So we have the core bond fund, which is a very high rated fund. And then at the other end of the spectrum, we have the credit income opportunities fund, which provides a lot more yield, but provides it with a little bit more risk. Having said that, it only has a medium risk rating. So to summarize, I don't think we're in a situation whereby we're going into recession this year. I'm optimistic that credit spreads will perform quite well this year. About the only thing that we don't like in the credit market is we're not a big fan of high yield right now. And the reason being is that we still don't think that you're getting paid to take the risk. We've taken the yield, our high yield exposure down pretty materially in our funds. We don't own very much of it, and primarily because the yield, the credit spread on high yield right now is at about 4.5%. And if you look back when we were, when the economy looked like it was slowing down in 2016, high yield spreads got out to about 900 over, so almost double where they are right now. And again, I'm not saying that we're going into recession, but I'm just saying the economies will grow at a slower rate this year. So credit spread of 450 over and high yield doesn't make a ton of sense for us. So high yield is something that we're not looking forward to buying, and we will reduce our exposure to that overall. So I think we have a great setup of products. As I said, we have the core bond fund, which should earn 3.5 to 4.5 this year. It's a very high quality bond portfolio. We have the diversified bond fund, which should earn 4 to 5%. It's available in corporate class and the credit income opportunities fund, which is my favorite, primarily just because I think this is a good environment for making a good return in credit.